Coming up in today's show, stocks fall following comments from Jay Powell, sending the 10-year Treasury yield to 5%, an update on the latest out of the Middle East, which is sending oil higher, jobless claims come in lower than expected, Tesla falls 10% after earnings, and are we on the cusp of another 1987-style stock market crash? Hey, what's up guys? Welcome back to the Click Capital Daily Market Show, your number one go-to source for all things financial news and analysis. And if you haven't already, hit that subscribe button, as I make these videos every day after close to keep you updated on the latest financial news, data and charts. And stick with me today because I've got a good one for you. I think the stock market could be on the cusp of a big sellout. I'm going to show you some charts as to why I think that could already be in motion, and we've got things heating up in the Middle East as well, which I'll get into in a bit. First, let's just take a quick look at the heat map from today. We had some more vicious down moves in some individual names like we saw yesterday. The biggest being Tesla, coming off over 9% and still trading down after hours as I speak. We saw some sharp moves down in the semiconductors. Financials still getting hit, led down by Blackstone, and with REITs and healthcare taking a bit of a dive as well. And just giving you a bit of an update on one of the biggest risk factors out there for markets, the war between Israel and Hamas. With still lots of fighting going on around the Gaza Strip, and the US Department of State just issued a worldwide caution advisory, asking all US citizens overseas to exercise increased caution due to increased tensions, the possibility of terrorist attacks, more demonstrations, and possibly kidnappings. We've got President Biden just about to make a big address shortly as I speak right now, and him and his team are really trying to cool things over there as they don't want it to escalate and cause the price of oil spike. However, it could already be getting a little out of hand, with news just hours ago that some other Islamic militant groups fired some rockets at a US military base, causing some injuries in southern Syria, close to Israel, with also some missiles being fired at a US Navy ship that were intercepted. And so just like a fight in a bar can spill over into a full-on brawl with many others, that could be happening in the Middle East. That's why we're seeing oil prices climb again. And we can see that in the daily chart of crude oil futures, which had been consolidating around the 50-day for the last 3 sessions. And we've just popped back up to a multi-week high, almost getting up to $90 a barrel today. And this market is on edge and full of tail risk at the moment. And we can already see a bit of a flight to safety in the price of gold. It too almost getting up to that big $2,000 an ounce level today, again on strong volume, which has been a pretty good move for both hard commodities considering the strength in the dollar holding above 106. And that's not good news for the Biden administration, who wants to be re-elected this time next year in the US federal election, and so they're trying to get ahead of this issue by peeling back sanctions against Venezuela, allowing them to export more oil and help boost global supply to counteract which could be more supply constraints coming out of the Middle East, who are kind of the big swing factor in the global supply of oil. So currently Venezuela produces about 800,000 barrels of oil a day. That's down from a peak of more than 3 million. Global output is 101 million, and they've been under sanctions for the last 4 years. And part of that deal to lift those sanctions comes with a pledge by their government to set up free elections next year. So this is a big risk for the Biden administration, as oil ripping over $100 a barrel would put a big dent in his political power, the US economy, inflation, and the consumer in general. And this plays right into Russia's, Iran's, and China's hand by squeezing the US and the Biden administration at a time when the strategic petroleum reserves at 41-year lows. So we also might see US oil production step up on top of the deal they just did with Venezuela, which saw their sovereign bonds soar 90% on the back of this news. In addition to oil, this geopolitical conflict and escalations is a boon for defense stocks, as the Biden administration wants to send tens of billions of dollars in support to Israel and Ukraine at a time when US federal debt is already running away to the upside. And we can already see in this chart here, defense spending is broken out to the upside this year, reaching above 10%, and Biden's looking for another $70 billion to help Ukraine and Israel. And that's going to help keep a bid in defense stocks like Lockheed Martin, which bucked the market trend today and finished higher. And we've still got other defense contractors trading real strong, like Northrop Grumman, General Dynamics, and L3 Harris Technologies. So even though we've got escalating geopolitics and war in the Middle East, there was initially a bit of a flight to safety to US treasuries after Hamas initially launched their surprise attack onto Israel's citizens. However, that didn't last too long, and yields are back up to new highs, and we saw further rallies in yields today on continuing strong economic data for the US economy, with weekly jobless claims coming in at 198,000, a bit below the estimate of 210,000, and a sign the jobs market is remaining pretty tight and the economy is holding up pretty good, which is leading Fed Chair Jay Powell to make a few hawkish remarks in his speech today, saying that rates could remain higher for longer. They need to stay there until inflation comes back down to 2%. And even though they're acknowledged that the rise in long-term yields could be doing their job for them, they're not going to try and step in and they're just going to let bond market volatility play out. He goes on to say markets have been volatile. You've seen the rates moving up and down a lot. I think we have to let this play out and watch it. For now, it's clearly a tightening of financial conditions, and so we'll be watching it carefully. And we finally did it today. The US 10-year just hit 5%, only a matter of hours ago as I speak. And just taking you out to a clean monthly chart of the 10-year yield, we can see we haven't been at this level since back in June 2007, right before the global financial crisis was starting to hit later that year into 2008. And just look at that steep rise in those long-term yields. Taking you out to a 3-month chart, that's the biggest and steepest rally we've had in bond yields for more than 40 years. And just flicking over to the monthly chart in S&P 500, it's truly remarkable how well stocks have done in the face of that and just holding up there. However, just going back down to the daily chart, it could be starting to fall over again. We've got a lot of charts breaking down, some strong volume on the downside today. And there's the weekly chart. We're pushing right up against this trend line. Started from the October low last year. And stick with me because I'll come back to this one later on in the video and show you some other charts and markets that could be pointing to further downside yet. So the bond market's currently in the midst of its biggest drawdown and bear market in its 250-year history. We've got the largest bond ETF hitting a 16-year low, and that's TLT, which is down over 50% since its high in 2020. And just looking at the daily chart, it had been trying to make a bottom this last couple of weeks. Was potentially setting up for a double bottom divergence. Looks like we've just clean taken that out today. Finished on the lows down more than 2% on above average volume. And so bond prices are still in a strong slide lower. It's hard to tell exactly when the bottom will be put in as this momentum is really strong. And part of the reason we're seeing a huge rip in bond yields has been the massive issuance of bonds from the US Treasury over the last 6 months, increasing the federal debt by over $1.5 trillion and bringing a spotlight onto the huge interest repayments on that debt now. And with the US needing to step up spending on military and its commitment to help other countries secure their borders, that debt's going to stay on a sharp uprise. And if the US economy were to go into recession, causing a decrease in tax revenue, that's just going to magnify the problem for the US government and their debt and the market's long-term confidence in them, and that should help keep upward pressure on rates for a long time yet. And so part of the reason why the stock market's held up so well in the face of the most aggressive Fed rate hiking cycle in history is that the economy's held up remarkably well throughout that time. We can see that in the unemployment rate still at 3.8%, and things have just kind of been trickling along sideways. However, that can't last forever. Interest rates and stocks can't keep going up in tandem forever. One of them has to take a significant fall. And that's why we got large asset manager Blackstone President Jonathan Gray saying Americans are about to feel the impact of soaring bond yields, as higher bond yields are raising borrowing costs all over the economy from mortgages to personal loans. He goes on to say when 30-year mortgages and car loans cost you 8%, it will impact consumer behavior. And with those excess savings from COVID stimulus payments starting to really dry up and student loan repayments starting back up, consumers' resilient spending spree could soon grind to a halt with rising debt costs. Even Elon Musk is worried about where interest rates are at the moment in the US economy. Spooking investors of Tesla and the market pretty good yesterday afternoon on his earnings call, coming in on a real somber note and downplaying things quite a bit. He said, I am worried about the high interest rate environment that we're in. He said, I just can't emphasize this enough, that the vast majority of people buying a car is about the monthly payment. And as interest rates rise, the proportion of that monthly payment that is interest increases naturally. And looking at the price action in Tesla shares, the market seemed to really take note of what he said. We finished the regular session down today 9.3%, currently selling off another 1.2% after hours as I speak, and right back down near those lows we made in the middle of August, around $215 a share. So we'll see whether that support zone can hold, as this is one of the biggest stocks in the market and the stock with the most traded value, and so it has a big impact on overall market sentiment. And we can see prices traded sideways for the last couple of months. However, we may be close now to breaking down throughout that, so we'll be keeping a close eye on this one. And so that sharp rise higher in long-dated bond yields is really upsetting the traditional 60-40 portfolio that Wall Street has typically recommended, and a lot of retirement funds are kind of based around a similar mix. And we can see that in this chart here of the correlation between S&P 500 and long-term treasury bonds sharply rising back up after a period of them being very uncorrelated since basically the early 2000s, and a similar pattern that we saw in the mid-50s going into the late 60s, where bonds and stocks were moving in opposite directions. And then going into the early 70s, they spiked up and pretty much stayed there for the next 30 years. And this is on the back of the worst annual return for the 60-40 portfolio last year, down about 18%. And currently this year we're only up 6.7%. And while we saw stocks and bonds move in opposite directions over the last 20 years is because of low interest rates. which really helps bonds, starting from a high point, and stocks as well. However, just like the 70s and the 80s, we had a period of really high interest rates, and that saw the correlations increase. And we could be going into that same period for the next 10, 20 years as well. At a time when we've got a lot of boomers just getting into retirement with their diversified stock and bond pension portfolios, when we're going into a time of big structural change in financial markets, like we can see in this chart here of the total return of long-term treasuries adjusted for inflation, you can see throughout the period of the 70s and 80s high interest rates, adjusted for inflation, treasuries were losing ground pretty steadily for a number of decades. However, once interest rates peaked out in the early 80s, then we went on a 40-year secular bull market in bonds. Those long-dated bonds delivered really solid gains for years, and a lot of people, their entire career, all they've known is increasing bond prices and stock prices as well. However, that looks like it reached a peak in 2019, and like all bubbles, they come off very sharply, and like the old saying goes, the market takes the stairs up and the escalator down. Prices come down a lot faster than they go up, and who knows where the bottom is in the bond market. Because like this chart here from Bank of America, interest rates just a year and a half ago are coming off 5,000-year lows. They managed to find data and chart rates going back to 3000 BC. And apart from the early 30s, briefly getting down to low short-term rates on the back of the 29 crash and Great Depression, long-term rates were never as low as what we saw going into COVID and the year of 2020. So it's no surprise that the bond market is in its worst drawdown ever after coming off the lowest rates ever. And long-term rates are still not back at a long-term average, which is more closer to 6%. Moving on to economic data today, there's jobless claims coming in a bit lower than expected. Out soon is inflation data from Japan, with retail data out from the UK tomorrow along with Canada, and then just a few more Fed speakers to finish the week out. Even though we saw that jump in long-dated bond yields, we haven't seen the similar movement up the front in short-term rates, as we can see in the Fed Fund futures today. Now back down to just a 1 in 3 chance the Fed will hike in January, and I think we'd really have to see some strong CPI prints to come in for the Fed to do that, because they already know the long-dated bonds are doing the work for them and tightening the economy. So at this stage, it would be pretty surprising to see the Fed add fuel to that fire. If anything, they're probably going to try and cool it off a bit. And the market is nervous here. Fear and greed index on the cusp of moving into the extreme fear zone. Corporate insiders not buying the dip at all, actually increasing the amount of stock they're selling. And just looking at the charts of the Nasdaq Qs after hours, we're trading down a bit here, 0.3%. We've got Biden's speech coming up. And I'll come back to the main US indices at the end of the video like I do every day. First, let's just go through all the other markets to see what else is going on out there. So we've still got international stock indices turning back down. There's German DAX taking out multi-month lows. China's index selling off hard, breaking down. A little bit of a turn down in the Nikkei, and Aussie 200 coming back down to test that support as well. And look what we've got here. The VIX breaking out. Multi-month highs, finishing the day at 2140. Now closing above 20 for the first time in what seems like forever. Volatility has been so suppressed for the last 6 months. However, that could have been a big bottoming process. And just look at the weekly chart. Typically, the market doesn't bottom unless the VIX spikes over 27, 30, sometimes even 35, getting towards 40. And we can see a bit of a flattening in the volatility term structure as well. And volatility, the VVIX index breaking out, along with volatility risk premium now at 8.3 points, and a bit of backwardation with the front month VIX futures contract now trading above the second month. And this is typically a pattern we see when the market's getting really nervous. And every time where there's been a crash, we've seen this backwardation up front and the VIX futures contract happen first. Along with bond market volatility, still holding up there pretty strong. The market is definitely getting a bit more nervous, and option dealers are requesting more premium to sell option contracts. And was a pretty busy day for a Thursday in options market. 42.7 million contracts traded, and people buying more puts again at 51%. And my strategy that you can follow on the Collective 2 marketplace only bears that only takes short positions, sitting really close to all-time highs here, and currently up 39% year to date. If the market does lose that trend line and falls, this strategy is going to crush it, and is already ranked in the top 3% of all strategies on the platform. Click the link below this video to learn more if you're interested. Getting back into the charts, we saw breadth take another dive today. 32% of stocks above the 20-day average, and the same trend with stocks hitting new lows versus new highs. Again, more pronounced on the Nasdaq, 188 new lows versus 11 new highs. The growth versus defensive sector spread closing below its 50-day again. High beta stocks finding multi-month lows versus low volatility. Still got growth versus value holding up a little bit. And the commodity growth spread, copper versus gold, really breaking down this last week, hitting new lows for the year, which is not a good sign for upcoming global economic growth. And look at that, the spread of gold versus treasuries just absolutely ripping up today, 3.3%, just showing you that safe haven trade is gold and not treasuries as it usually is. And commodities versus stocks in general coming back up to multi-month highs. And look at the steepening in the 10-year, 2-year yield curve, just absolutely ripping back up. It's like we've been seeing short-term rates kind of stalling out with the idea the Fed is pretty much done, but we're seeing those long-term yields just keep ripping higher on the back of huge treasury issuance. And if I just invert this chart, take off all the indicators and overlay it with the S&P 500 in the orange line here, just zoom out a little bit, we can see after the regional banking crisis back in March, we saw a sharp steepening in the yield curve, along with stocks falling off. Then it kind of stalled out, along with stocks, went back to deep inverted territory. And then since then, there's been quite a bit of correlation with stocks and the yield curve inverted, with a bit of a gap from where we are now. So stocks are actually holding up really well considering the move higher in long-term rates. And just looking at a long-term chart of the yield curve, you can see we've been record inverted in depth and time. However, that's coming back up to zero. And remember, it's when it goes from below to above zero that usually a recession is around the corner. And look at the move higher inflation expectations by looking at the spread of inflation-protected treasuries versus regular treasuries. Again, this is the market saying we are in for higher for longer with inflation and rates. So even though the 2 years stalling out, it's holding pretty steady at 5.16. And it's really the move in the back end, the 10-year and the 30-year, now at 5.10%. With this huge amount of momentum persisting, it's really going to take something big to turn this around. And we've even got high-yield bonds now in a strong short-term downtrend after they've been trading sideways pretty much all year, coming back down to the next major support zone at around $71 a unit on the high-yield corporate bond ETF. And that's another bad sign for risk assets here as well. There's Bitcoin holding up a bit there, floating with $29,000 a coin, and the commodity complex as a whole having a good day, getting back up to close to highs. Got gold approaching that big lifelong resistance zone just above $2,000 an ounce. And the big one for crude will be $90 and then that $95 resistance zone. Over to stock sectors, was a sea of red, except for the cannabis ETF, which was the winner today, along with gold miners finishing the day higher. Clean energy, the hardest hit sector again, along with consumer discretionary breaking down on volume. Home builders finding new lows again. Airline jets, financials coming off a bit, and the second hardest hit sector, REITs, really don't like the climb in those rates. And utilities looking to peel away from their 50-day as well. With BlackRock trying to find a bottom after earnings, and pretty flat sideways action from the big guys. Apple kind of jammed between this resistance and support zone. Same deal with Microsoft, just trading sideways now for a few months. Probably the best one out of the pack is Google. Amazon below its 50. NVDA jammed between resistance and support as well. And the other big one in the market, Tesla, as we've already covered, breaking down pretty significantly here today. We'll just see whether it can find support around 215. Contrasting the weakness today was Netflix, coming in with an okay beat, earnings per share up 7% higher than expected. And I think, again, another dead cat bounce, finishing the day up over 16% as their crackdown on password sharing has apparently resulted in more subscriptions. Meme space is still pretty weak, with one of the leaders this year, Carvana, now in a strong short-term downtrend. And there's the second biggest asset manager in the world, Blackstone, reporting worse than expected earnings today on both the top and bottom line, down 7 and 10%. Really not a good sign for the health of the market when you've got a huge asset manager like them reporting weak results. There's Birkenstock, which fell 3.2% today, down another 1.3%, and rejected off that VWAP pretty good, as I pointed out a couple of days ago. Still got Israel stocks sliding lower, and the snack makers coming off a bit today, with Swiss giant Nestle taking a bit of a hard fall, down 3.4%, and some of the other stocks we've been watching, NextEra Energy, General Motors, Walgreens, and 3M, all coming back down to their lows from a couple of weeks ago. See whether they can hold up. Got a strong bounce from AT&T today. They just reported their last quarterly earnings, 64 cents a share, showing it's still really good value for a $15 stock, making 64 cents a share for the last quarter alone. That also helped Verizon trade up a bit, and they report in 5 days. This Carl Icahn stock breaking down to lows not seen in over 10 years, and a bit of a nasty move down in vulnerable regional bank Zions. Even though they came in line with expectations, market didn't like the report and sold them off pretty hard, and still got Charles Schwab trying to defend its earnings from Monday afternoon. Okay, so just looking at the S&P 500 here, we're back down into this trend zone that we started from October last year, then joined on March in the regional banking crisis, and now we've just rejected off the 50-day VWAP. And we've got a number of indices like the equal weight S&P 500 coming back down to these lows, along with mid caps and small caps Russell as well, actually breaking down, closing at the lowest level all year, and we're now actually down year to date on the Russell 2000. And look at micro caps breaking down even harder again. So that, combined with the VIX starting to wake up here and close above 20 for the first time in over 6 months, along with a huge rip and long dated yields, the oil market's still on edge with the Middle East conflict and the Biden administration scrambling to get ahead of that. And we just so happen to be on the 30-year anniversary of the Black Monday crash in 1987. When stocks fell 20% in one day. Could it be a Black Friday tomorrow? I mean, all the ingredients are there. However, don't forget, we've always got the Fed put, and just like we saw back in March, if anything bad were to happen, they are trained to step in the next minute and support markets, open whatever window needs to be opened, and the algos will step in and take over. However, as we sit right now, stock market's right on this edge here on the trend line. Things can get a bit spicy on Fridays, especially since it's OPEX tomorrow, the third Friday of the month. Going to see a bit of volume in the options market, and let's see if the option dealers can win, because we've got Max Payne around 43.30. That's the optimal level for option dealers tomorrow when the most amount of options will expire worthless. So they'll be looking for a bounce. However, as you can see from my sector trends table, there's a lot of downward momentum out there, especially right up the front now. Most sectors below their 5-day moving average, with the real standouts being oil, gas, energy, and the gold miners, showing the most amount of green. Just about everything else is breaking down to multi-week or multi-month lows. And typically really bad things happen when the market is already sliding downwards. And just looking at the price action of the S&P 500 in 1987. You can see we're already trading weak. That was the Friday of the 16th of October, and that was the Monday. S&P 500 fell over 20% in one day. And guess what else we had back in 1987 going into that crash? A ripping 10-year government bond yield, which because of the crash also had a big correction that day as well. So another big sell-off in the market could potentially be around the corner. If not tomorrow, maybe next week, especially if these yields keep ripping higher and things boil over in the Middle East. Interesting times, no doubt. Thank you very much for sticking with Click Capital. My name's Jared, and I hope to see you again tomorrow afternoon. Cheers.